What if the biggest financial opportunities in America appear at the exact moment everyone else is panicking? While most people freeze during economic crashes, wealthy investors quietly buy stocks, real estate, and businesses at massive discounts. In every major financial crisis, from 2008 to the recent market sell-offs, the rich didn't run away from fear. They bought it. So why do wealthy people keep getting richer during recessions while the middle class struggles to survive? Today, we're breaking down the real strategy behind crisis investing and why fear is often the richest people's favorite signal. Welcome back to The Dollar Pilot. When financial markets crash, the average American reacts emotionally. People panic, sell their investments, stop spending money, and wait for better times. But wealthy investors often do the exact opposite. They start buying assets aggressively while prices are falling. And this isn't a conspiracy theory. It's a pattern repeated throughout American financial history. During the 2008 financial crisis, millions of Americans lost homes, jobs, and retirement savings. But while fear dominated the headlines, some investors quietly purchased undervalued real estate, stocks, and businesses. Over the next decade, many of those assets multiplied in value. The same thing happened during the COVID-19 market crash in 2020. The stock market collapsed rapidly, unemployment surged, and fear spread everywhere. Yet billionaires and large institutional investors were buying heavily, while average investors were selling. So why does this happen? Because wealthy people understand something most people don't. Crises create discounts. When panic takes over, asset prices often fall faster than their actual long-term value. Stocks become cheaper, real estate slows down, businesses struggle temporarily. Wealthy investors see this as an opportunity to buy quality assets at lower prices. This is one reason Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." The rich also have one major advantage during economic uncertainty: liquidity. Most Americans live paycheck to paycheck. Rising inflation, credit card debt, high rent, and healthcare costs leave little room for investing during hard times. But wealthy individuals usually keep large amounts of cash or easily accessible capital ready for opportunities. That means when markets crash, they can act quickly. And historically, long-term investors who bought during major downturns were often rewarded later. For example, after the 2008 recession, the S&P 500 eventually recovered and reached new all-time highs. Real estate markets rebounded. Tech companies exploded in value. Investors who stayed patient benefited massively from compound growth. This is why many wealthy people focus on assets instead of liabilities. Assets are things that can grow in value or produce income over time. Stocks, businesses, rental properties, index funds, or even dividend-paying investments. Meanwhile, many Americans are trapped spending money on liabilities that lose value quickly, like expensive cars, high-interest debt, or lifestyle inflation. The wealthy often use crises to increase ownership while others are trying to survive financially. But there's another reason rich investors buy during fear. They think long-term. Most retail investors focus on what happens next week. Wealthy investors often think in decades. When markets crash, they ask one question: will this asset still have value 10 years from now? If the answer is yes, temporary panic becomes less important. This is especially true in the stock market. Historically, the U.S. stock market has survived recessions, inflation spikes, banking crises, wars, and political chaos. Yet over long periods, the market has generally continued moving higher. That doesn't mean crashes are easy. Fear is powerful. When you see headlines about recession, layoffs, inflation, or market collapse, the emotional reaction is to protect yourself immediately. Social media amplifies panic even more. Every downturn suddenly feels like the end of the financial system. But wealthy investors understand market psychology. They know emotional investing often destroys long-term wealth. This is why strategies like dollar-cost averaging became so popular among long-term investors. Instead of trying to perfectly time the market, investors consistently buy assets over time, regardless of short-term volatility. During crises, that strategy allows investors to buy more shares at lower prices. And over decades, compounding can become incredibly powerful. Now, this doesn't mean rich people always win or that every investment works out. Plenty of wealthy investors lose money too. But their mindset is usually different from the average person. They focus on ownership. ownership of companies, ownership of real estate, ownership of productive assets. Meanwhile, many Americans are stuck in survival mode because wages haven't kept up with inflation, housing costs continue rising, and consumer debt is exploding across the country. That financial pressure makes it much harder to invest during uncertainty, and this is where the wealth gap often grows wider during recessions. People with cash can buy discounted assets. People without savings often struggle just to cover monthly bills. This is why financial education matters more than ever. Understanding investing, personal finance, inflation, and asset ownership has become critical in today's economy. Because the reality is simple, the financial system often rewards ownership more than labor alone, and the people who understand that early usually position themselves differently during crises. Instead of asking, how bad will things get tomorrow? They ask, what opportunities exist because everyone else is afraid? That mindset shift changes everything. Now, obviously, nobody can predict markets perfectly. There's always risk involved with investing. Markets can stay volatile longer than expected. Recessions can become painful, and people should never blindly buy assets without research. But history shows one consistent trend. Fear creates opportunity for prepared investors. That's why wealthy people continue buying during economic uncertainty, while many others pull away from the market entirely. At the end of the day, the rich aren't simply buying assets. They're buying future potential. And in many cases, they understand that temporary panic often creates long-term wealth opportunities. So the next time you see fear dominating headlines, remember this. Some people see crisis, others see discounts. And that difference in perspective can completely change someone's financial future. If you enjoyed this breakdown, make sure to subscribe to The Dollar Pilot for more real-world insights on investing, financial freedom, the U.S. economy, stock market trends, and building long-term wealth in today's changing economy.